to The Educated Trader. I'm Dr. Alex Mosley, and I'm going to take you through the very basics of trading principles. This lesson, the third, is about how we may begin to identify the start of bull, bear and sideways markets as early as possible, which may be very useful in helping us form a strategy for our own trading system. In the previous tutorial, we looked at the major moves a market can make, but our analysis was historical. We could spot the trending and the sideways markets after the fact, as it were. This has limited use for creating a strategy, though. We want to be able to identify the major market types, the bull, the bear, the sideways, as we move through time. Firstly, though, let's look at an abstract version to get an idea of what the ideal bull, bear or consolidation look like. Firstly, the bull chart. The reason for removing the noise of an historical market chart is to be able to give us an idea of what we are looking for without being distracted by the minutiae of temporary moves. A bull market is characterized by higher highs and higher lows. The angle of ascent may be high or low, but that relates more to the condition of the market, whether it is racing ahead or quietly plodding along without too much fanfare. The second chart is the corresponding bear market, which has lower lows and lower highs. Again, the angle does not matter, nor the depth of the pullbacks, which refer more to the condition of the market, whether again it is moving fast or slow. Higher highs and lower lows, or lower lows and lower highs, are the standard criteria of trending markets. If they are not occurring, then we do not have a clear trend, and we may have to look for further evidence that a trend may be starting. A quick way of identifying a potential beginning of a trend is a breach of the high after a low is tested. Putting a box around the high and low provides us with a clear graphic to substantiate our claim that a trend is starting. It may or may not get far, of course, but that breach is critical. The same is true of the bear market. We can identify a low that is breached, following a high, allowing us to create a graphical indicator such as the box of the parameters or the bounds, the boundaries. The market then proceeds lower. Let's look more closely at a trending market to see what issues come up. Now, this is an obvious trend, a bull trend, on the DAX, the German Equity Index, over a period of about a month. Let's take a look at where it starts first of all. So we're going to zoom in to the bottom left-hand corner and see how it performs and where it breaks down. Zooming into the first part, the 3rd to the 8th of October, which include a weekend, we can identify a series of 5 higher highs with corresponding higher lows. This is standard trending formation until the market breaks down after hitting 12,150 just after 5. There follows after this a period of uncertainty with a high at 6 not being challenged for 13 periods, that's 13 hours. Okay, these are overnight from the UK and the European perspective, and usually this can be a quiet trading period. But then there's a burst up to 7, which allows for a higher low at 7B, but then the next high at 8 was lower than 7, so there is no trend here. Now recall, this is at the beginning of what historically looked like a very long trend lasting a month. And this is markets showing that they are never so clear-cut. And we see here a battle between the bulls and the bears for some kind of direction here. From the 9th to the 13th of the month, a standard bull trend reasserts itself. We have a series of higher highs and higher lows, breaking down at the top of the diagram with the sequence of higher lows but not higher highs. These are lower highs. Indeed, somebody who's looked at technical trading may spot a head and shoulders pattern at the top, which is held as a predictor of a reversal. Now, this does partially occur after the head and shoulders routine, but then the market's bear trend doesn't really get started. From the 9th to the 24th, we see a return to the trend. that we were following on the previous slide. It ranges over to C before continuing. But we can see how messy the trend had become after the high of B. And there's a slight move to a trend within that before it gets to C, but that fails. What this shows again is how messy a trend can be. Now this raises lots of questions for us when exploring potential strategies. It may also give us a nudge to review a higher time frame, say, look at what's happening on the 4-hour chart for instance, or to use some indicators to assist what we're doing. Now that is more in depth than what we need at this stage. The next set of slides looks at the ranging, the sideways or the consolidation movement, or what I call the penguin market, which may help resolve some of the quirkiness that we're seeing in this example. Let's say a market reaches a high and then pulls back to a new low, and it bounces off that low. The high and the low give us the potential upper and lower bounds for the market, which we can identify with horizontal lines to see how price will react to these limits going forward. Blue indicates the upper price that the market has reached and green the lower price. Now this can be a useful graphic to see how the market behaves. If the upper or lower bounds are breached, then we may have a new trend starting. The price action will give us clues as to the unfolding market moves. Let's watch how an idealistic ranging trade may reveal itself. Now the market has moved sideways, constrained by the upper and the lower bounds. The original high and low act as our signposts, as it were, from which we can make a quick assessment of the market type, that it's consolidating or going sideways. This also gives us a clue as to what the traders are doing here. No one is succeeding in pushing the market out of this range for this period. Now, of course, the range may not happen at all. For instance, we had identified a high and a low, and we'd created the horizontal lines, but then a reversal bear trend move occurs, with lower lows and lower highs. There can be many variations on this theme, as there may be with the beginning of bull and bear markets. Now, let's take a good look at an example of a consolidation that behaves reasonably well. This is from the DAX, 10th of November to the 2nd of December 2016. We're on the hourly time frame, so each candle represents 60 minutes. We start off with a long bull move that touches 10,800. Then it retreats to around 10,575. This creates our upper and lower boundaries for the market, which can be very useful for identifying a potential trading range. We've certainly seen the long move broken by the reactionary bear move, passing, as it does, two pullbacks that occurred on the ride up. We don't know what will happen next, but for now we can see that the market is content to stay within the boundaries. Then we see another two attempts at the upper boundary, which fail. The market respects both the upper and lower boundaries, signifying that we have encountered a trading range. Then we have an attempt to break the lower boundary, which fails. After such failures, I typically move the boundary of the range to indicate its new limit. The market returns into the box until finally it does break through the lower boundary. Now let's review a more awkward trading range. We don't know that this is going to be an awkward trading range when we set the parameters, of course, but let's follow it through. We set the upper and lower boundaries to assess price action within the bounds. Then we see a slight poke through. This is called a fake out rather than the breakout, which allows us to move the upper boundary. The market remains in those bounds for a while before creating a powerful bull run through the upper limit, but that we can see soon retreats. This can again allow us to move the upper boundary. Now there is a challenge to the short side and the bears push through the lower boundary, but after some skirmishes, the market rebounds into its range again. We lower the lower boundary. The lower bound is tested again as the bears push through some volatile collapse in price to below the 13,000 before retreating into the band again. We can therefore move our low boundary accordingly. It is tested again to the right of the screen when the market pokes through the 12,900, which permits us to move the trading range again. Now this is followed by a strong bull run that tests the upper limit and breaks through, only to return to the 13,250 area, which has acted as a mid-range equilibrium throughout the period. So let's review what's happening here with a wider perspective. We can see that this activity continues well into the next month, and the range expands again and again, noted by the arrows, just for the prices to fall back. Now in this screenshot I have moved the upper boundaries, but we can also note how the price collapses through the trading range to the right of the screen, finally, and heads below the lower boundary. The price continues to fall precipitously in the wake of the lockdown policies of February-March 2020. Let's look at an idealized version of this. Price moves up and bounces on a low, and we can set our limits. The price then moves to higher highs, but also lower lows, and this continues over a period. We can certainly say that there is no trend forming. Instead, we have an expanding range. If we are looking for trending markets, these expanding ranges can be very annoying. On the other hand, depending on the size of the opening range, or as it grows, we may be presented with opportunities for reversals within the range. That is a strategy question. We can also look at the same period's consolidations differently by focusing on the localized ranging that occurs. For those of you who may be interested in breakouts, when the market breaks out of a consolidation, this may be a useful review. This is the first part of the consolidation we looked at, but now we're looking more closely at localized ranges. We see several boxes drawn to broadly represent the ranging periods. I've put blue arrows on to identify the trends that are occurring within the broad trading range. One thing we can spot though are several troublesome fakeouts from the little yellow boxes where the market pushes against an upper or lower limit and then returns abruptly into the box. Boxes C and D are not very good ranges at all. They're more like a volatile skirmish, but if we stick to our rule of marking the high and low for the range, we can see that both become an expanding range before the boundaries are broken. So let's have a review of the concepts we've noted in this section. Here are two idealized versions of the bull and the bear markets. And here is the ranging trade. And now we know things are never so simple. Here's the early trending market with the trends and the consolidation boxes added. Note the minor reversal at A, followed by a return to the bull trend, the long sideways market that has a massive fake out at B, and a new trend to C and the formation of a new consolidation. This is all good stuff to take in. Now in the next section we'll be looking at support and resistances and how they may help us gauge where markets have been and where they may be headed to. Thanks for listening. I'm Dr. Alex Mosley from The Educated Trader.